Reed, welcome to my podcast. I really appreciate your doing this so early in the year.
Yeah, no, thank you very much, and thank you for having me. It's a good week to have it. All predictions at this point can still be true
Right.
because we're
I
we're
love
all
that.
7 days in, so anything can still be true at this point.
That's a great point. I also like the fact that we're finally talking about something that is so critical, I think, to a lot of the deals that are happening in our space, but we generally don't give it much airtime. So I'm glad we finally have you over here to
No.
talk about private credit. Tell us a little bit about your role at Deerpath and about Deerpath's, lending model, especially as it pertains to IT services.
Yeah, so as you said, my name is Reed Van Gorden. I lead the origination team, also one of the originators. So what that means is me and my team are calling on primarily private equity sponsors to source the deals to support them when they're buying a company, growing a company during their hold period. We focus on the market of 100 to 250 million of enterprise value, which is typically 10 to 25 million of EBITDA. Broadly speaking, IT services, and I know we'll talk about a few different IT services today, but IT services is either our largest or one of our largest, depends on a given quarter. Sectors in our portfolio, and that encompasses everything from IT MSPs to digital transformation to some of these businesses that are reselling technology or reselling subscriptions of, like an Atlassian or different technology solutions, as well as web development or just kind of people doing outsourced service, kind of helping people with their tech stack, kind of the full continuum.
Mm-hmm. Why do you like IT services? What is it that makes it great?
Yeah, so they tend to have very strong revenue retention. And I want to separate here. There's recurring revenue
Mm-hmm.
and there's reoccurring revenue. And
Right.
recurring revenue, I think of, and I think most of the market thinks about as an annual contract. And sometimes these can be multi-year contracts,
Mm-hmm.
but I'm not sure there's a big difference in business quality if it's a 5-year contract, a 2-year contract versus a 1-year contract, because
Mm-hmm.
ultimately what you're looking at is what is revenue retention, and that normalizes for how long the contract is.
Mm-hmm.
That tells you really all you need to know. But
Mm-hmm.
overwhelmingly, these businesses tend to have very strong revenue retention
Mm-hmm.
because customers don't want to switch out their IT
Yeah.
provider, whether it is IT MSP. Why would you replace your help desk? Why would you replace your cybersecurity? Whether it's your firm rebuilding your apps or rebuilding your web, or rebuilding your hosting, why would you change it? Whatever it may be, why would you switch it out?
Mm-hmm.
Two, very strong industry growth that you're continuing to see strong demand. Um, Third, good customer diversification. Every once in a while, that doesn't always happen, and you have to be a little careful there because sometimes you'll get businesses that will have some customer concentration. And yeah, they tend to not churn, but what happens if that company's bought? Or what
Sure.
happens if that company really goes through a strategic change? That they're not just going to do it to do it, but if there's some real external factor, it may happen. And if that's a big customer, that could hurt your borrower or your business. Really, and then the fourth is healthy margin profile. Often 20%, like at least 15, sometimes as high as 25, and then very strong free cash flow. Every once in a while, maybe you have some capitalized software, but
Mm-hmm.
that's pretty de minimis, and
Mm-hmm.
most businesses don't have that. So you really have what the lenders are looking for, that you have very stable earnings, you have very diversified earnings, and you have very strong free cash flow generation. I guess the biggest negative at times is there might not be a ton of organic growth,
Mm-hmm.
depending on the industry, depending on the subsegment. Where
Mm-hmm.
if you're doing kind of an outsourced service or a digital transformation, maybe there's a whole bunch of white space. But if you're in IT MSPs, there might not be a whole bunch of white space. If you're in cybersecurity, there might be a whole bunch. So that's a little hard to do over the whole sector, but that can be the negative at times in some of the subsectors. Is you may have a really strong customer retention, but with that comes really low organic growth.
Do you have, from an underwriting standpoint, hard lines? So for instance, from time to time, I'll hear a lender saying, well, if the largest customer is more than 20% of, revenue, we just draw a line there. We wouldn't lend to that
bigger
type
than
of a profile.
20%, I would say, is just a pass. It's
Yeah.
the simple answer. I would say recurring and non-recurring, that's hard. I think it depends on the business. Like in an IT MSP, if they're less than 60% recurring revenue, I think then I would say they're not an IT MSP, they're a VAR. And then therefore, frankly, their margins are probably sub 10%. So I don't think I would be interested. So I'm not sure there's clear lines there. I think it more is, okay, then I question just how much is their value add, and I would just pass because there's not enough value add, because I would say they're a value added reseller of really product, not a managed service business.
Yeah.
I think there are some project oriented digital transformation or implementation shops that have pretty weak customer retention because it's a one-time implementation of a software.
Yeah.
With minimal tails. But then you're betting on their well-known in the market and winning. And if they've been doing that for a long time, you can get comfortable.
Yeah.
Are you going to be doing that at the same leverage you're doing a very high quality IT MSP?
No.
Absolutely not.
Yep.
But I don't think that means that company is not financeable.
Yep. Does it matter who the buyer is? Have you lent directly to MSPs? You always partner up with a private equity firm?
Yeah.
And why?
So, I would say typically we focus on sponsor backed. I would say IT MSPs are one of the subsectors that we think are good enough quality, and we've done enough deals that we would do a direct deal, and we have done one direct with founders, but that's an exception versus the norm. And to be clear, even with the private equity firm, it matters. Like every private equity firm is not the same. So I think absolutely it does matter. I would also say one of the hardest things to diligence is the quality of management. Yes, you can look at historical, you can go meet them, but I do just fundamentally think that is one of the hardest things to diligence. But it is probably the most important.
Yeah.
So I don't have a good answer there, but yes, I think the quality of management, the quality of the owner is of utmost importance.
Right. And I think your point there is, and the private equity investor is doing their due diligence on that, probably have a competitive advantage in doing that over you, which is why
and hopefully this private equity firm has known them for a long time.
Yeah.
Like I do think the market has evolved a lot where it is no longer, and I'm not sure it ever was, that a private equity firm just showed up to a banker process and it was the first time they met them.
Right.
The private equity firm has been following the company for a long time, has met him a couple times, has known him in the ecosystem. Just the same way we get to know the private equity firms. Like the first time I win a deal with a private equity firm is not the first time I met them.
Right. What is the typical leverage for a company that does 60% managed recurring revenues, is doing 15% EBITDA margin? So, from that standpoint, they're a healthy business. What are we talking about? Is it like a 5 turns leverage, 6 turns?
4.5 to 5 times. It depends a little on EBITDA.
Okay.
Size, I would say, kind of, let's call it 10 million of EBITDA, kind of probably high teens EBITDA margin. Kind of to your point, recurring revenue north of 60 is probably 5 times leverage. I don't think that necessarily goes for 15 times, but probably goes for 12 times EV. Yeah. I would say on the kind of more generic, like IT services, they all tend to be kind of 4 to 4.5.
Mm-hmm.
Every once in a while, something can be pushed north, kind of closer to 5, depending on the kind of customer data. But really, it's the customer data that spits out kind of where you fall in the leverage, because that normalizes for a lot of different things.
Yeah. And what is the nature of the loan? Is it tenor and like fixed floating and secured unsecured?
Yeah, so we are exclusively top of the capital structure, first lien, senior secured, floating rate. So based on SOFR. LIBOR no longer exists. It's now SOFR. They're in essence the same, but it's now SOFR. Floating, in essence, something based on Fed funds rate. Plus a spread. And then term is 5 to 6 years, give or take.
Okay.
Some are 5, some are 6. That's somewhat negotiable. But today, I would say all-in cost of debt is kind of 9 to 10%.
Okay.
So if kind of base rate is kind of mid to high 3s, spread is kind of, let's call it 5 plus fees. So kind of in that 9 to 10%.
What are things MSPs can do today? I know they can already glean a bunch of this from the responses you've already provided, but a few things MSPs can do today to help ensure they get your best terms.
Yeah, one of the new terms I heard this year was a data cube, which I'm still not sure I can really define.
Okay.
But I think the biggest thing is customer data. Have clean customer data that matches. Don't make the buyer or the banker have to figure out how to match up customer names and customer data. Yeah, fine. If you want to provide it on blinded for the first round, like I respect that. I respect your kind of proprietary and kind of sensitivity, but provide clean customer data, because that's going to be one of the most important things. Yes, obviously financials are going to be important, but hopefully if you've hired a banker or you're running a process, your financials should be in decent kind of order.
Yeah.
But I think that customer data is very important. Another thing increasingly is data on like producer concentration and salesperson concentration.
Oh, okay.
And understanding how those relationships work. And like a good example would be your consulting business. In the consulting business, it may show, and we've seen this, 2 people control all the relationships if you look in your CRM.
Right.
I don't think that's the way you would think of it. But if you do a CRM export, that may be the way it shows to people.
Right.
And if that's not the way it is in reality, I think it's in your best interest to make sure you've cleaned up your data to show it correctly or to show it appropriately. Because some of it may just be legacy coding. That
100%.
This was the founder of the business, and this customer has been with the business for 15 years, and they brought him in 15 years ago.
Yeah.
And now the founder hasn't talked to this customer in 12 years.
That's a great example, because like that literally happens so many times with these businesses. 100%.
And then we have to then piece it apart,
right,
and explain it to our investment committee of, is that a risk or not?
Right.
And sometimes it is, and sometimes it's not.
Yeah.
But I think it's that, and then typically you don't have vendor concentration, but if you do, you should understand that. But typically you don't. But I think the biggest thing is customer data.
Yeah.
And maybe for some businesses it's the producer or kind of salesperson. And then I guess the new thing is just a discussion of AI, because everyone's going to ask. Everyone's going to ask, and I would hope you have some opinion or trial or something